Good morning, everyone. Welcome to this week's episode of the Green Gauntlet. As always, 5 questions from farmers and potential prospects. I'm Josh. This is Patrick. You ready to go?
I am.
All right. Okay. First question this week. Will summer weather cause a rally in greens?
It usually does. It's called weather premium being added during the growing season. We usually don't have absolute perfect weather everywhere in the Midwest or Corn Belt, soybean belt, however you want to phrase the location. And so we had dryness in some places, too much heat in others, too much rain in others. And we usually get some weather premium added because of that.
Absolutely. I mean, you see at least $1 range typically on corn and wheat and $2 in soybeans. It has to come from somewhere. If it's not news, it's going to be weather.
That's correct.
Okay, good. Where do you think soybeans can rally up to in the short term?
Wow. 11 to 1150 is where I would be looking at making some sales on old crop. And we would get aggressive at that price range also for new crop.
You think that's possible?
I do, because again, what you just said, normal price range $2. So that would be right now. If you consider this the low around $10, which I do, we could get as high as 12.
Okay. All right. This one, overheard this question. It says, if I have a cash flow in the unit, isn't around the time of a sale recommendation, is it okay if I call in and tell you what I need to do so we can build some kind of plan or protection around it?
Yeah, it's called buybacks. We can do buybacks. So if we have a sale that we're not recommending at the time and you have to have cash flow, we definitely individualize things for our clients. So somebody has to sell 20% of the corn to get some cash flow going. We'll look at where the price is, what we think the price will be, and we'll target a specific hedge recommendation based off where we think we're going to make the sale. So if we think we're targeting 20, 30 cents higher, we're not going to go with futures and take that kind of risk. That would be defeating the purpose of cutting risk by making the sale. We'll target something like a bought put, sold put, where we can make 30 cents and get our target. That kind of position has a lot less risk than straight futures, and it's usually fixed. So even making the sale early is sometimes a less risky thing to do.
Yeah, I really appreciate this question because I like being able to get the message out there that we customize this to everybody. So different people have different needs. Everyone has different
In spaces,
exactly.
so cash flow needs, ownership of land, input cost differences.
And we want that. Yeah, we want that info. We want to know. If you need to make sale, let us know. We can adjust your plan accordingly.
Correct.
Okay, good. Other than confirmation on acres, isn't the ending stocks estimate the most important aspect of this coming planting intentions report?
Ending stocks for new crop will not be calculated, although in the report, because it's not a supply and demand report, although the market will calculate by using what the USA is expected to use, 181 bushel yield for corn and 52.5 for beans. You take the planted acres, subtract the acres, get down to the harvested acres, and then multiply that by the yield, and you'll have a production number. So quarterly stocks is very important. That's also on the 31st report. It gives us the quarterly stocks through March 1st, which will tell us how many bushels have disappeared and are no longer available to sell. If that number is lower than expected, that's bullish, because that means a 1.5 billion bushel ending stock will come down. Everything in fundamentals affects the final ending stock number. Planted acres, harvested acres, yield, demand, quarterly stocks, all that has to be taken into consideration. It ain't changing any one of the numbers will affect the bottom line ending stocks.
Okay. All right, and this last question is from a prospect. I think it's a fun question. Hopefully you do too. I was talking to a client and I described you as a graduate level options trader. And that prompted the question, I was asked to elaborate. So, without giving away the farm, describe how you hedge differently.
Wow. A lot of traders use bold call spreads, simply buying a put, selling a put, buying a call, selling a call. I think that is high school level. You got to understand basic option strategy to be able to do that. A lot of producers have worked with futures, but never really delved into premium of time value. The fact that sold options are much more successful, much more probable to make money on a sold option than on a bought option. So what I do is I use a combination of bought and sold options. We look at different months, time value. We look at short-dated options when they work the best. For example, one of the things we discovered over the last year is when you enter into a short-dated option, like say buy or sell a September $5 put, there's 15 cents of time value in that September put. That means by the time we get to the end of August, if you sold that $5 put, 15 cents would come to you no matter what, because it's time value. So no matter where the futures ends up, you're going to collect that 15 cents of time value. And if the market rallies, what we have noticed is sold short date options lose their time value rapidly. For example, right now, if you look at May in the money puts, short dated puts, again, gives you the right to declare short futures in December by the end of April. If you look at it, 20, 30 cents in the money, there's no time value left in those options. It's already gone. So we look at a lot more than just simply buying a bold call spread or selling a bought put against us, buying bought put, selling a sold put. We look at months, seasonal trends, everything. And I've been doing trading options. I've been trading options since they came out in the mid 80s. And they are very, very complicated the more you get into them. That's graduate level option trading, in my opinion.
Yeah, absolutely. Definitely. It takes a long time for new clients to pick up the gist of things, and then some of them, honestly, I can hear that it's just more of a trust thing with you. They don't even to this day maybe fully understand it, but they see the results.
Yeah, the one thing we have to get through to our clients is the risk reward on every trade we put on, and that is difficult when you have options because the risk reward can change. If we have a quick rally, that risk is different than a slow rally, or vice versa. But we explain the risk as much as we possibly can. And for my clients, because we use complicated option strategy, I always try to work within what they want to put into the hedge account. And that is the risk tolerance that we try to work within always. When there's a margin, then we have to either change the risk tolerance or liquidate down and continue working with the next parameter. As always, up to the founder.
Absolutely. Sounds good. All right. Well, good questions this week, everyone. As always, watch to the end of the video. You'll see the email address to submit your own questions, and hopefully we'll get a question for you and we'll answer here next week.
Easier questions next week.
Has a good week. Sounds good. Have a good week, everybody. Thank you.